Let's cut straight to the chase and talk about the two NFOs which are open. Start off with the Edelweiss US Technology Fund. Now, a lot of people have been talking about how it might be great to diversify even geographies and get into the other markets. We are going to be doing a show on that too, by the way, but that notwithstanding, this is probably an offering which gives you, in a manner of speaking, some exposure. Have you guys looked at the NFO and what do you think about it? Either of you can start.
Right. So as the name suggests, this is a US technology fund. Edelweiss, it's a fund of funds, feeder fund actually. It will invest into JP Morgan US Technology Fund. As the name suggests, it is likely to, as per investment mandate, it will invest into new technologies, something like cloud computing, big data, or even disruptive technologies. It has stocks like Lyft, it has stocks like Microsoft, it has stocks like Synopsys, etc., etc. Basically, it's a thematic. I wouldn't call it a specifically sector fund, but I would call it a thematic fund. So it's a thematic fund. So what you are getting by investing into this NFO, if you choose to, are two things. One is you will get a geographical diversification. If currently all of your assets, financial assets, so to speak, are, if they are invested into India, a geographical diversification is what it will get you, and it will also get you some kind of exposure to new technologies. So that's what this NFO is mainly about. As always, I would also like to cover one additional point. Sector, geographical, or thematic diversification can be anywhere between 5 to 10, 10 to 15% of your overall portfolio. So if you have a space within that space of 10 to 15%, you can probably look at this offering.
Okay, I want to come to you on that as well. But Vishal, any thoughts that you have, whether it's a subscribe for you or an avoid for you? Because even for diversification, there might be other options. So is this fund a good option, or would you choose some other funds if one wants to adopt the mutual fund route for geographical diversification?
Correct. So as Amol rightly said, this is a fund of fund, and the base fund is the JP Morgan US Technology Fund. Now that's a 20-year-old fund, and it is fairly actively managed and has investments in what we call as emerging technologies. Now US, as we all know, is the hotbed of technology. So the JP Morgan fund invests in technologies like cloud computing and 5G, autonomous cars, etc. So these are technologies which are already in the market but are yet to reach the mature phase. So there's a lot of growth which is still left in these sectors. So even if you see the portfolio of this fund, I mean the top 10 stocks includes names like AMD, which is in the semiconductor industry, or say Salesforce. Also there are mature companies like Microsoft, Alphabet, etc. So investors can get a wide variety of technology companies to invest in. So Indian investors already have, probably there are 2-3 funds in the industry which are investing in the US market. But this may probably the only fund which will invest in emerging technologies. So from an Indian investor perspective, they have a chance to invest in this upcoming technologies. So having said that, I've got a couple of caveats for the industry. One, for the investors. One is that the US bull market is now in its 11th year.
Sure.
So that is one thing which investors need to keep in mind. Secondly, these technologies are upcoming in nature, so they're emerging. So there are chances of some failures, etc. So investors probably should come via the SIP route, have at least a 5-year horizon while investing in this fund.
Okay. Just wondering, what is the kind of expense that you pay in this one vis-a-vis maybe some of the others? I mean, I don't know what are directly comparable, but I believe Motilal Oswal has an international offering, DSP has some international offerings, and PPFAS has a fund which invests directly into global stocks. So, one, on the prospects to comparable funds, I don't think PPFAS is a direct comparison, but two, even on those, a comparison on the cost as well. Are all the costs, etc., all synonymous? Because returns only time will tell.
Let me talk. So let me talk about the expense. The underlying fund, as both of us mentioned, is JP Morgan US Technology Fund. That fund has expense about 86 bips, 0.86%. Now SEBI, as per the regulations, does not allow you to jump over the 2.25% mark. So the India fund, I mean to say the Edelweiss NFO, that fund is likely to have about 1.3 sort of an expense ratio. Both expense ratios put together, investor is probably paying around 2.25% of expenses in this fund.
Is this comparable to some of the others in the thing, or are there others with a lower expense ratio?
Okay, so some of the funds that you mentioned are index funds or ETF. So this is an actively managed fund, although the Edelweiss fund is a feeder fund, but the host fund or the US domiciled fund is a actively managed fund. So the costs are not strictly comparable. Actively managed funds, even in your local or domestic Indian mutual fund context, have at a higher expense ratio levels. The same holds good for this NFO as well.
Okay, Vishal, Amol mentioned a point about how you could have some diversification in the global funds as well. My question is, let's assume somebody has space. Would this NFO be an optimum candidate for filling up that space, or would you use some of the other existing, whether ETF-based funds or the PPFAS model or some other?
I think this fund can be part of the portfolio, honestly, because if you see in the US market also, technology is now having the lion's share of the total market cap. So it makes sense for an Indian investor to probably participate in this space in some or the other way.
Okay. So,
Neeraj, I have a bit of a controversy, so if I can have few seconds
please.
on it. Okay. So if this is your first outing in terms of, this is the first international fund, you could probably look at a diversified equity fund.
Sure.
Because all said and done, we also have had a tech sort of a boom, tech sort of a year 2000, Y2K, we all remember that. So if this is your first outing, I would suggest to look at a diversified. This is not to say good or bad thing about this NFO, but I am saying that always start with the most common or most basic element of the market. So people also ask this question about banking and financial services fund in India. This fund has done so very well, but this fund accounts for about 40% of market cap of index itself. So even if you buy a diversified fund today in India, you are probably getting a 40% exposure in any case. So I would say that a technology fund, it's slightly for a thematic fund, is slightly for a slightly evolved level
investor.
and not really for the first time investor.
Okay, point well taken. So I hope that viewers answers some of the questions if you had and if you were considering investing in this fund. There is another NFO, which is the Sundaram Balance Advantage Fund. Now, Vishal, I want to start off with you on this one. What's your view here on Sundaram Balance Advantage Fund? What kind of investors, and are there other comparable options or better options?
Sure. So this one comes in the category of dynamic asset allocation funds. So basically, funds in this category can invest in equity and debt also, both asset classes. Now Sundaram specifically can invest up to 100% in equity, as the scheme information document mentions. If it feels that the markets are undervalued and they like the equity markets, then they can go up to 100%. If they feel that the markets are not undervalued, and if they feel the volatility is high in the market, then they can go up to 100% in debt as well. So there is a broad area in which the fund can invest. Also, there is a mandate to invest up to 50% in the derivatives segment. So that is also something which investors need to keep in mind. The fund will always try to capture the equity taxation, so that is good for the investors. But having said this, there are already comparable funds in the industry. And as a category, if you see the premise of a dynamic asset allocation category is that the fund will invest more in equity when the markets are down, and it will invest less when the markets are up. But if you see the returns of the last 3 to 5 years, the category has given only 8 to 10% kind of returns. So I would say investors are probably better off sticking to known names, which are already part of the industry as of now.